Welcome to Finantax Clips, where we simplify complex financial concepts for you. Today, we're diving into the world of car payments and credit scores, two topics that may seem unrelated at first glance, but are actually quite intertwined. You see, car payments and credit scores are like two sides of the same coin, each affecting the other in ways you might not initially realize. First, let's break down these concepts. Car payments are essentially the monthly payments you make towards the loan you took out to purchase your car. These payments are scheduled over a certain period, often stretching over several years. When you make a car payment, you're not just paying for the vehicle, you're also paying the interest that accrues on the loan. Now, let's talk about credit scores. In the simplest terms, a credit score is a three-digit number that lenders use to determine how likely you are to repay a loan. It's based on your credit history, which includes how much debt you have, how often you make payments on time, and how long you've had credit. But here's where it gets interesting. Your car payments can directly affect your credit score. How? Well, when you make your car payments on time, you're showing lenders that you're a responsible borrower, which can boost your credit score. On the flip side, if you consistently miss or make late payments, this can negatively impact your credit score. Understanding the relationship between car payments and credit scores is crucial, especially for car owners. Why? Because a low credit score can make it harder for you to secure loans in the future, not just for cars, but for homes, education, and other major life purchases. Plus, a higher credit score can also mean lower interest rates, which can save you money in the long run. So whether you're a first-time car owner or a seasoned driver, having a grasp on these concepts can be a game changer for your financial health. Stick around to learn how high car payments can affect your credit score. Firstly, unpacking car payments. What does it mean exactly? Let's dive right in. When you hear the term car payments, it's essentially a comprehensive term that includes multiple components. The principal, interest, and fees are all part of this. Let's start with the principal. This is the original sum of money borrowed to purchase the car. Essentially, it's the sticker price of the vehicle that you've agreed to pay. Every time you make a payment, a portion of that goes towards reducing the principal. Next, we have the interest. This is the cost of borrowing the money, which is typically a percentage of the principal. The rate can vary greatly based on a multitude of factors, including your credit score, the lender, and the current state of the economy. The interest is calculated on the remaining principal, so as you pay down the principal, the interest portion of your payment decreases. Then we have fees. These could include registration taxes and any other charges associated with the loan or the vehicle purchase. Fees can be rolled into the loan amount or paid up front, depending on the lender and your personal preference. Now, what influences these car payments? Three key factors come into play here: the loan term, interest rate, and loan amount. The loan term, or the duration over which you repay the loan, significantly impacts your monthly payment. A longer term means lower monthly payments, but it also means you'll pay more in interest over the life of the loan. A shorter term means higher monthly payments, but less interest paid overall. The interest rate, as we've touched on, is essentially the cost of borrowing money. A higher interest rate means a higher overall cost for the car, while a lower interest rate means less cost. Your credit score, the lender, and the current economic conditions all influence the interest rate you're offered. Finally, the loan amount. This is the total amount you're borrowing, including the price of the car, any extras you've added, minus any down payment or trade-in value. The higher the loan amount, the higher your monthly payments. But it's not just about understanding these components, it's about knowing how they interact. For instance, a longer loan term might mean lower monthly payments, but it also means more interest paid over time. A higher interest rate can significantly increase the cost of your car, especially over a long term. And a larger loan amount will, of course, result in higher monthly payments. So it's not just about the monthly payment, it's about understanding the total cost of your car and how your car payment fits into your overall financial picture. Remember, a car is a depreciating asset. It loses value over time. So consider the total cost, not just the monthly payment, when deciding how much car you can afford. Understanding your car payments is the first step to managing your finances effectively. So the next time you're considering a car loan, remember to look beyond the monthly payment. Consider the total cost and how it fits into your overall financial plan. Scene script. Next, we delve into the world of credit scores. But what is a credit score and why does it matter? We're glad you asked. A credit score, in its simplest form, is a numerical representation of your credit worthiness. Picture it as a financial report card that lenders, landlords, and even some employers use to gauge your reliability. It's calculated based on several factors from your credit report, including your payment history, amounts owed, length of credit history, types of credit, and new credit. Let's break that down a bit more. Your payment history, which includes whether you've paid your debts on time, carries the most weight. It accounts for about 35% of your score. Following closely is the amount you owe, which makes up about 30%. This includes the total amount of debt you have in relation to your credit limits. The length of your credit history, the mix of credit types you have, and the amount of new credit you've recently obtained are also considered, though they carry less weight. Now, you might be wondering, well, what's a good credit score? Credit scores typically range from 300 to 850. A score below 580 is considered poor, while a score between 580 and 669 is fair. A good credit score falls between 670 and 739, and a score between 740 and 799 is very good. If you're lucky enough to have a score of 800 or above, you're in the excellent category. So why does your credit score matter? Well, it can greatly influence your financial opportunities. Lenders use your credit score to decide whether to lend you money and at what interest rate. A higher credit score generally means you'll qualify for better interest rates and terms. On the flip side, a lower credit score can mean higher interest rates or even being denied credit altogether. Your credit score can also affect your ability to rent a house or apartment. And some employers check credit scores as part of their hiring process. It can even impact your car insurance rates. In short, your credit score can play a significant role in many aspects of your life. To sum it all up, a credit score is a three-digit number that lenders use to assess how likely you are to repay your debts. It's based on a variety of factors from your credit history, and it can have a considerable impact on your financial opportunities. Whether you're applying for a loan, renting an apartment, or even applying for a job, your credit score can be a key factor in the decision-making process. So, your credit score is like your financial report card, and it can greatly influence your financial opportunities. It's crucial to understand your credit score, how it's calculated, and how to improve it. After all, a good credit score can open doors to better financial opportunities. Now that we understand car payments and credit scores, let's explore how they're linked. In the world of credit, every action has a reaction, and the way you handle your car payments is no exception. Let's dive into the details. The relationship between car payments and credit scores is actually quite straightforward. In essence, it boils down to one key principle: consistency. Consistently making your car payments on time can have a positive effect on your credit score. This is because the credit bureaus, the entities that calculate credit scores, monitor your payment history closely. They keep an eye on whether you're paying your bills on time, and this includes your car payments. Now, let's imagine you've been making your car payments on time for a year. Month after month, you've made sure to meet your financial obligation. This consistent, timely payment history demonstrates to the credit bureaus that you're a responsible borrower, and as a result, they're likely to reward you with a higher credit score. But what happens if you miss a payment or pay late? Well, that's where things can get a bit tricky. You see, missed or late payments can negatively impact your credit score. This is because these actions suggest to the credit bureaus that you may be a risky borrower, and as a consequence, they may lower your credit score. Now, it's important to note that a single missed or late payment isn't likely to tank your credit score dramatically. However, if this becomes a habit, or if you're significantly overdue on your car payment, your credit score could take a substantial hit. In fact, payment history accounts for 35% of your overall credit score, making it the most substantial factor in the calculation. And it's not just about the numbers. A lower credit score can make many aspects of life more challenging. It can lead to higher interest rates on loans and credit cards, difficulty getting approved for housing, and even higher insurance premiums. So it's in your best interest to make your car payments on time, every time. But what if you're struggling to make your car payments? There are options available. You could consider refinancing your car loan for a lower monthly payment, or even sell your car and opt for a more affordable one. The key is to take action before you miss a payment and your credit score takes a hit. So, the morale of the story here is quite simple. Managing your car payments effectively can act as a stepping stone to a healthier credit score. By making your payments on time, every time, you can demonstrate to the credit bureaus that you're a responsible borrower, which can in turn help to improve your credit score. Managing your car payments effectively can act as a stepping stone to a healthier credit score. With all this information, what can we do to ensure we're on the right track financially? Well, it's time to delve into some practical tips. Firstly, let's talk about managing car payments. One of the simplest yet most effective ways to stay on top of your car payments is to make them on time. It might seem obvious, but you'd be surprised at how many people overlook this crucial step. The consistency of timely payments not only helps you avoid late fees, but also plays a significant role in maintaining and improving your credit score. Secondly, consider setting up automatic payments. This way, you won't have to worry about forgetting to make a payment. Plus, it ensures that you're making at least the minimum payment every month, which is pivotal in maintaining a good credit score. Thirdly, try to avoid taking on excessive debt. While it can be enticing to upgrade to a more luxurious model or add another vehicle to your collection, remember that every loan you take is a commitment to pay back. The more debt you have, the harder it can be to manage, and the more it can affect your credit score negatively. Moving on to improving your credit score, a great strategy is to keep an eye on your credit utilization rate. This rate is the ratio of your outstanding debt to your credit limit. A lower rate is better for your credit score, so try to keep your debt as low as possible. If you have multiple credit cards, try to spread out your charges among them to keep the utilization rate low on each one. Another tip for improving your credit score is to regularly check your credit reports. You're entitled to a free report from each of the 3 major credit bureaus every year. By regularly checking these reports, you can spot any errors and have them corrected. This can prevent your score from being negatively affected by inaccuracies. Lastly, remember that improving your credit score is a marathon, not a sprint. It takes time and consistent effort. Don't be discouraged if you don't see immediate improvements. Keep making your payments on time, manage your debt effectively, and regularly monitor your credit report. In conclusion, managing car payments effectively and improving your credit score are closely linked. While it might seem daunting at first, with these strategies in hand, you'll be on your way to financial stability in no time. Remember, it's not just about making car payments, but managing them smartly. So there you have it, the truth about high car payments and their effect on your credit score. We've delved into the intricacies of car payments and how they're broken down. We've also demystified credit scores, helping you understand how they work and what influences them. The key takeaway is the significant impact your car payments can have on your credit score. We've seen how making regular timely payments can boost your score, while high payments or missed ones can lead to a dip. We've also shared some handy tips to manage your car payments effectively and improve your credit score. Remember, it's all about being smart with your finances. Prioritize your payments, keep them manageable, and you'll see your credit score soar. Thank you for tuning in to Tax Clips. Please subscribe, share, and like our channel for more simplified financial concepts. Remember, understanding your finances is the first step to achieving financial freedom.